Hello, Mark here from Success with Options. Today I want to continue with the video series that I started a couple of weeks ago on diagonal spreads. In the prior video I covered the overview basics of a diagonal spread using slide presentation, talking primarily about the theory of trading diagonal spreads. In this particular case I want to demonstrate this on the Thinkorswim platform. In this video I'll focus specifically on demonstrating the analysis and trade entry portion of the diagonal spread, and then we'll come back with another video and talk about trade management and trade exit. Another thing we'll see demonstrated on the platform is one of the niftiest new features of the Thinkorswim platform, and that's the Think on Demand capability, which allows us to go back and replay different events in time. They actually capture tick by tick some of the trades, and so we're actually looking at the IWM chart here as it was the morning of March 2nd, which is when we put this trade on. So in terms of the analysis of this trade, we can see that we've gone from kind of the highs back in January, we've hit some lows down here in early February, and now we've quickly rallied back up and we're poised to actually break out over the top of this level. We've seen a couple of bullish indications, not only just a strong move up, but we've seen the strong move up, a slight pullback, and then another strong move up and a breakout over this level. I'm looking at this thinking that this would be a really good candidate for a diagonal spread. So with that, let's switch over to the Thinkorswim platform, and we're going to go to the Trade tab and talk about the trade setup itself. Now the first thing I want to cover is strike selection. We want to make sure that in the short strike we have at least 20 days until expiration, much like we do for a lot of our option strategies that we trade. In this particular case, the March options only have 17 days, not quite enough. Now we have some March quarterlies, which a lot of the index products do, and in this case we're going to go ahead and look at trading the March quarterlies because they have 29 days until expiration. In terms of selecting the long strike, we could look at the April because it's got 40 days, which is within our window, or we could look at May because May would give us actually two potential rolls then. One roll from March quarterlies to April and another roll from April to May, which would leave us with a long, hopefully in the money vertical spread. In this case, I'm going to favor the May options for this particular trade. Let's go ahead and expand the option chain and take a look at our choices here. Now, I talked in the prior video about wanting to select a strike between 75 or between 0.7 and 0.8 for our long strike. In this case, we could pick the 61, the 60, or the 59. Depending on our preferences. I'm going to go ahead and go a little bit deeper in the money on this particular trade, and in this case I'll select a strike that's going to be 0.8. So the 59 May call is going to be our long call that we're going to select as an initial starting point anyway. Now let's go ahead and expand the March quarterlies, and for the short strike we want to pick a strike that has a delta between 0.25 and 0.30. Well, the only option that has a delta in that range is the March 66. So basically what we're going to do is we're going to set up a March 66 trade. So I'll right mouse click. I want to buy a diagonal spread. Now the Thinkorswim platform sets us up for what's more traditionally a out of the money diagonal spread. So we'll have to do a little bit of adjustment here. Remember, we went with a May long position, and we want to go with a 59 strike, and we have our March quarterly 66 call, and we're currently seeing that trade at 577. Now our first quick off the cuff analysis that we want to do on this is to determine whether or not this trade will make any money for us and whether that the risk that we put into this trade is worth the investment. So we can do that really quick by analyzing the spread, which is $7, and subtracting from it the cost of entry, because if the trade ran all the way up to, let's say, $80, then we would be fully in the money on this trade, and we'd probably be assigned on our short, and we'd be forced to exercise our long position, and we'd basically be out of the trade for the width of the spread in terms of our profit. Not a bad thing. So let's do a quick analysis and find out if that's going to be worth it for us. So let's go ahead and look at a $7 spread minus 577 is going to give us $1.23. $1.23, and we divide that by our initial investment of 577, And we can see that we'd have about a 21% return on this trade if this thing ran really strong and we didn't have a chance to do any rolls on the trade. And that's not a bad position to be in, actually. So that initially looks like a pretty decent potential trade. The other thing that we want to do is look at potential roll values before we go too much farther. The way that we can do that is we can switch from single to calendar view. Actually, we want to switch from single to calendar, and we're going to go with a 2-month, 1-strike calendar. That will allow us to analyze a roll from March to April, which is roughly going to be equal to the roll we'll make from the March quarterly to the April. So what I want to do is go ahead and go into this and look at our date, and we'll go ahead and pick a date that's about a week before expiration. That'd be about the 15th, because the 19th is the expiration. So we have about a week until expiration. Now if we look at this 66 call position, we can see that the roll value would be worth right around 71 cents. That's kind of an ideal value, but we could see that we might be able to get as much as 71 cents on the roll. And remember, we have a roll from the March quarterlies to April, which might not pay quite as much, and then we'll have a roll from April to May, which would give us the 2 rolls that we're expecting. So right now we're looking at a combined roll value of about $1.40 on the position. So if we look at that $1.23 and combine it with about $1.40, we're looking at about $2.63 on as a potential profit. And if we compare that to our initial investment of about $5.70, we're almost at 50% return on investment, which is pretty darn good, I would say. Let's go back to our single. We're at a point now where we need to analyze how many contracts we should trade. Now if we look at this on the surface, we could say that our max risk is going to be about $5.76, and that's going to be a little more than our portfolio can stand. So what we want to do is consider other possible exits. Now in a lot of my debit trades, like calendar spreads, diagonal spreads, and long vertical spreads, I often set a loss limit of about 50% of the initial investment. So if we look at that, the loss limit of $5.76 divided by 2, so 50% would be about $2.88. Now we have a portfolio, let's say, of about $18,000 to trade, and we want to risk just 2% of that. So that's going to be $360. So that means that we could take just one contract in this particular position and remain within our risk limit. So what I'll do is I'll go ahead and lower my contract amount to 1 contract, and we're ready to enter the trade. Okay, as we've been talking, we've actually seen this price drop a little bit, so let's go ahead and do a confirm and send on the trade, and we're in. So let's quickly go over and look. We have a delta of about 0.47. We have a theta, a positive theta of 0.6, and a vega, which is positive, of 1.8, 1.77. This is vega, a positive vega, because of our calendar spread component of this trade. So that's going to actually benefit from an increase in volatility if such a thing happens. Okay, that's pretty much it for this video. Stay tuned for the next video where I'll cover trade management and trade exits. Happy trading.